Is this the start of a market rebalance? It's a question more investors are beginning to ask, quietly at first, but with growing urgency, because beneath the surface of rising headlines and familiar winners, something is shifting. Not dramatically, not all at once, but slowly, steadily, and in a way that smart investors are paying very close attention to. For the past several years, the market has been dominated by a narrow group of high-performing sectors, especially technology. Fueled by innovation, low interest rates, and massive liquidity, these companies have delivered extraordinary returns. And naturally, that's where most attention has gone. But markets don't move in straight lines forever. Eventually, leadership changes, capital rotates, and what once led the market can begin to lose momentum. That's where the idea of a rebalance comes in. A market rebalance doesn't necessarily mean a crash. It doesn't mean everything falls apart. Instead, it often looks like a shift in leadership, where money quietly flows out of crowded trades and into areas that have been overlooked or undervalued. And right now, there are signs that this kind of rotation may already be underway. One of the clearest signals is valuation. Many of the most popular stocks are trading at historically high levels compared to their earnings. That doesn't automatically mean they're bad investments, but it does suggest that future returns may be more limited. Smart investors understand this. They don't just look at what has performed well, they look at what still has room to grow. At the same time, macroeconomic conditions are changing. Interest rates are no longer near zero. Inflation, while fluctuating, has reshaped how money moves through the system, and global uncertainty, from geopolitical tensions to supply chain disruptions, is forcing investors to rethink risk. In this kind of environment, diversification becomes more important than ever. And that's exactly what institutional investors are doing. Instead of concentrating heavily in one sector, they're spreading capital across multiple areas, many of which haven't been in the spotlight. Industries like energy, industrials, and materials are starting to see renewed interest. These sectors tend to perform differently from tech, especially in periods of economic transition. They're often tied to real-world demand, things like infrastructure, manufacturing, and natural resources. Financials are another area drawing attention. Higher interest rates can actually benefit banks and lending institutions by improving their margins. While this sector has faced challenges in the past, smart investors are looking at how the environment has changed and where opportunities may now exist. There's also a growing focus on defensive sectors. These include industries like healthcare, consumer staples, and utilities, areas that tend to remain stable even when economic conditions become uncertain. They may not deliver explosive growth, but they provide consistency. And in times of transition, consistency becomes incredibly valuable. But perhaps the most important shift isn't just where money is moving, it's how investors are thinking.